Hello and welcome to this Energy Quick Chat where we rub minds with stakeholders and players in the energy market. Now, the oil outlook on global oil demand continues to send mixed signals across the market, while the IEA is forecasting global oil demand growth will average just less than 1 million barrels per day in 2024. OPEC, on the other hand, maintains a bullish stance, forecasting demand growth of 2.25 million barrels per day. BP revised its global forecast for oil and gas consumption, presenting two scenarios for 2024 through to 2050, in which both commodities dropped significantly within the period due to rapid growth in renewables. So I have Julien Mathonniere here speaking to me to give us that update on what's going on in the markets. Julien, how are you?
A very good day to you, Justina. Thank you for having me. Yes, I'm very good. And yes, it's been a very sort of busy market. So I'm very glad we're going to discuss it together today.
Right. Now, so can you set the stage for us on where the global oil market is at the moment?
Sure, of course, Justina. So I'd say it's a market of two minds. So far, I'd say the first half of the year, demand has been a bit disappointing, especially the first 5 months of the year. But there is still hope that the market will improve in the second half of the year. We'll see larger deficit, and this is going to support the price and to support demand. So if you look at the price of Brent oil, it's been holding at more or less $85 per barrel for nearly 1 month. But if you look at the price structure, it has moved into deeper backwardation. So the price for immediate delivery is higher than the price for later delivery. And this is because there's expectation that crude balances in the third quarter will get tighter. So, markets are still looking at an average deficit of 1.2 million barrels per day this year, with tighter balance in the second half of the year. Next year, however, balances flip into a sizable surplus, potentially approaching a 1 million barrels per day surplus. And the huge supply deficit we see this year, they increasingly reflect, if you want, OPEC plus withholding supply rather than exuberant demand. So I would say this is something you have to keep in mind. This is not so much about exuberant demand. This is about OPEC, keeping some sort of hand, keeping some sort of control on this market. So it makes the situation very tricky for OPEC plus, because they might have the space to unwind their cuts in the second half and bring back some barrels. But if they do, they might have to cut back again next year. I'd say that's the overall situation at the moment.
Right. That's interesting. So, with all of this, what's your take on both OPEC and the IEA's recent global oil market outlook? We have those divergent views and worries about if OPEC will be able to balance the markets and hold on to prices without the voluntary cuts or not. So, what's your outlook on that?
Well, it's interesting that you've just used the word divergent, because I'm using that word as well. And I think the answer is there are differing views on China. I think that was the most shocking aspect that came out of the reports this week. Both forecasters' views on China have been steadily diverging. According to the International Energy Agency, China's oil product consumption contracted in April and in May and is now below its year-ago levels. So, it's not improving compared to 2023. It's not doing as well, basically. It's degrading. And, the IEA has used the word, I think they said China's preeminence is fading. That's the expression they use. China preeminence is fading. They wrote that in the report yesterday, highlighting that China's share of global demand growth has receded from about 70% last year to an expected 40% this year and next year. So the IEA now sees China, China's oil demand growing by only 415,000 barrels in 2024. And if you remember, back in March, their forecast for China was 600,000 barrels. So for 600,000, they're now down to 415. And back in March, when their forecast about China was 600,000 barrels, the forecast from OPEC was 630,000 barrels. So, IEA and OPEC were almost the same about China in March. Now they've completely diverged. We've got 415,000 for IEA, and I think OPEC is now at 873,000 barrels. So more than double the IEA. That's just incredible. Their views on China are at loggerheads. They're going in opposite direction. And I think for me, that was the most shocking aspect of their reports. They're completely different views about Chinese demand.
Right. Now, BP 2 days ago had its energy sector outlook report out as well, and still maintained that having those two scenarios where seeing that oil prices will still, oil demand, however, will still have that peak, just as the IEA had said earlier on. Do you align with BP's latest energy outlook report for 2024 and beyond?
Well, we do align, Justina, with BP on the fact that renewable power sources, such as, for example, solar and wind, are failing to grow rapidly enough everywhere in the world to meet the projected growth in energy demand. So if you take Europe, for example, policies have been playing a major role in the deployment of more sustainable energy sources. It's also working. More people are using solar panels, maybe just one or a couple, on the roof of their houses to supply like renewable power to their own houses. I'm sure that if you take Africa, however, policy support is almost inexistent outside, say, like maybe fuel subsidies. And fuel subsidies, of course, are for oil and gas, not for renewable power or for solar and wind. And therefore, if you want to deploy renewable faster, then I think rich countries must intensify their support to poorer nations. And this is exactly what BP said. And I think we are in complete agreement with that. Now, BP also expects oil demand to peak by 2025 at around 102 million barrels per day. And renewables, so wind and solar again, capacity to grow rapidly in their two scenarios. The two scenarios you mentioned, current trajectory and net zero. And this is driven primarily by the falling use in road transportation. Now, we at Energy Intelligence see demand peaking a bit later by 2029 and at a little higher, like 105, 106 million barrels per day rather than 102. So this is where we are a bit different with BP. But that sort of gives you an idea of we align with their renewable views, a bit less with their old peak sort of timeline and number.
Because they also mentioned something about energy addition and energy substitution and having to where that balances out as well. And however, having seen all of these forecasts from BP, OPEC, and the IEA, and including the U.S. Information Energy Agency as well, how should traders and investors tailor their portfolio and risks from various perspectives that we have on the table?
It's a very good question, but it's a very tricky one. I think there's no single answer to this question because it depends in large part on the risk profile of investors. So what we've learned from the recent earning calls from energy companies is that investors are still divided between favoring a sort of cash cow model that maximize dividends, that maximize profits, and diversifying their investment from fossil fuel to avoid the wider systemic risk linked to the energy transition. So, there's a bit of a contradiction. They're divided. They want money, but they're also aware that they have to put more money into the energy transition. A bit, they're divided. An investment in oil and gas, of course, is still at least twice more profitable than investment in renewable. So I think that's the big problem, you see. And since the average cost of capital has risen from about 3% to 6% with the global rise in interest rates, after central bank decided to hike their interest rates, so the US, Europe, everywhere, basically, then tolerance for low returns seems to be lower. So, investors, they want some returns on the money they've invested. And we see shifting sentiments around capital allocation as the main driver behind, if you want, the recent strategy shifts at major oil company. Energy security concerns post-Ukraine, coupled with, strong oil and gas profits and shareholder returns, have weakened investors' tolerance for oil and gas. They're more tolerant for oil and gas staying in the landscape a bit longer. And corporate ambitions to help accelerate the transition, they've also sort of given way to more passive roles, but will follow policy and demand uptake. So, they will follow what the governments are deciding rather than being proactive in sort of supporting renewable. So that's a bit of a slight change compared with what we've seen, in the past 2 or 3 years. We see investors still heavily committed to the transition, but they prefer to let the market allocate the capital and decide. That's what we see.
Oh, right. Right. Just allowing the market just take its course and just keep watching. At least I know where to keep my money and know where to invest it right now. So what other key developments in the industry are you focusing on at Energy Intelligence?
Well, I'm looking very much of the market, so I will mention only 3 which are market related. One is it's the nitty gritty, but we look at refining margins. I know that sounds very dull, but it's the telltale sign of oil demand. In Europe, refining margins have struggled because of underwhelming gasoline demand. Now, summer driving season, summer flying season is there, especially in the US, in Europe as well, and the outlook is suddenly improving. This is why you see this Brent price sort of holding at 85, 86. They are doing better because refiners are doing better. But you may have seen this report from Goldman Sachs a couple of weeks ago saying that China's refining throughputs were at a 20-month low. So, China is not doing very well. And Brent is now above $85 per barrel, which is a price which tends to prove a pain point for China. At this price, they don't like to buy so much crude. Which brings me to my second key development. I will look at China. China is the elephant in the room. I keep saying that all the time, but it's the oil market's primary growth engine. And it has failed to deliver the kind of boost that forecasters expected this year. China looms large in every demand projection for 2024. It makes up 45% of our 2024 demand projection of 1.2 million barrels per day. It makes 40% of OPEC's 2.2 million barrels per day projection. So, it's big. You cannot ignore China, and China is not doing very well. Margins are 1% below last year. They're still thinking about limiting or cutting their runs. That doesn't speak to rising demand, at least the rising demand or the fast expanding demand that OPEC is thinking about. So that's my second point. And the third point, of course, as you imagine, we will look at US elections. See the elections in France, see the elections in the UK. Everybody is focused, but these are small countries. The US is important because whether Biden or Trump wins may not make a huge difference for the oil and gas industry, but it will make a big difference in terms of energy transition as well as in terms of business and trade environment. So, everybody will be focused, especially on the US, but everywhere, everybody will be focused on the US election, I'm sure.
Right. And then we also saw the UK banning oil drilling on the North Sea as well. So all of these things just have an impact on how the markets will go eventually. Julien Mathonniere, oil markets economist at Energy Intelligence. Thank you so much for sharing those insights with us and keeping watch on those numbers and developments in the market. Thank you so much. And that's it on our Energy Quick Chat. Thank you everyone for watching and taking time to watch and make your comments. Keep making your comments, like and subscribe to see more videos like this. Follow Frontier Africa Reports across all our social media handles. I am Justina Okechukwu. Bye for now.